our job is to write good business, profitable business, right? Agency owners get paid, bonuses for profitability, right? So we use a term in the industry, loss ratio. You can think about it. For every dollar of premium written, there's admin costs, cost to adjust claims, claims paid, agent commissions, all the expenses that kind of come out of it. And then what's left over at the end is the profit to the carrier, right? It shocks a lot of people to know that like most carriers feel like they're printing money if they make 2 cents on the dollar on auto insurance, right? So yeah, and it's funny because a lot of times insurance carriers, especially around the pandemic, there's this like narrative that vilifies the carriers when they are profitable, and they don't buy yachts and go to the Bahamas. They put that money on reserve because the cycle is going to come back around and they're going to get hammered, right? I think Allstate lost $422 million in December to end out the quarter. State Farm lost $2 billion last year. So there's a lot kind of like going on from a worst case scenario, Nick. Claims can hit your policy to the tune, a typical surcharge is 30%. That usually lasts like over about a 3-year period, and you'll usually see a taper down on year 5. It should be back to 0. That is exclusive of market increases, right? So if you're in a situation where pipes explode on the 3rd floor and you got $85,000, $95,000 water claim because of plumbing, and then market dictates a 15% increase in addition to that, you could potentially be looking at 45% plus. And then, when you get into 5 and potentially 6-figure policy premiums, it can be a smack. And then obviously divide that by your per door and see how that affects, profitability. So
it was only 77,000.
Yeah.
It's pretty bad.
Yeah. We had a lady just, single family home, tree fell in her house. It was 61 grand. So, okay. Another thing that's going on is cost of claims is subject to inflation too, right? So like as contractor materials, labor, that kind of thing goes up, there's this additional expense that when the rates were calculated for last year wasn't included, right? So if we have the same frequency and similar severity of claims in the same policy year, but inflation's up 8%, it's going to cost us more as a carrier to adjust that, right? The only way that we can recover is going back to the policyholder. If water starts to drain out of the pool, we got to refill the pool, right? It just is what it is, right? All the boats were flown to the top. So there's going to be additional challenges for shopping insurance on properties that you currently own if you suffer rate increases. We talked a little bit earlier about those underwriting guidelines, right? So a few years ago when I met Brian and Jana, they'd call me and they'd say, "Yo, we need coverage," and I'm like, "Done. No inspection. Don't even worry about it." And things would just sail through. Now it's like our conversations go a lot more like, "Hey, I need to the day when these systems were replaced, I need somebody on the roof looking at this. Somebody's got to go through and change all the batteries on all the smoke detectors. Somebody's got to make sure that we got recharged fire extinguishers under every sink. If you got exterior stairs, hand railings, all this stuff has to be really, really like drum tight." So one of the things that we try to do as an agency is shift how Trey talked earlier about like that underwriting process that a lot of the people in the room that are more experienced multifamily purchasers look at is like, does the desk underwriting, does the math make sense, right? But one of the additional things that I would encourage you to look at is a metric that it's insurability, right? So when you get those loss runs, severity and frequency, was it property related? Was there casualty? Did the previous owner allow certain breeds of dogs that will not be named? Were people allowed to grill on the wood decks? Like, so there are things we can't control: fire, wind, lightning, hail, and things that we can control by partnering with our property manager, setting good guidelines. Some of the scary next things that are going to be happening is with these challenges, there are some additional underwriting metrics that are being developed that are really more like software company. So I'll give you an example. Typically when we were underwriting a property, we would have just your usual stuff, right? What's the year of the roof, electrical, HVAC, plumbing? Have we had any loss in the last 5 years? What's your current premium and deductible? How much coverage do you need? Great. Roof's brand new. We got new construction, not in a flood zone. Like, everything looks great. Let's write it. They're extending what they're looking at on the casualty side to tenant mix, right? So one of the new metrics that's being developed and sort of being inputted by carriers on the back end of their systems is who lives there. What does their personal loss history look like? Do they have a lot of auto accidents? Do they have liability losses? Have they ever had a dog bite loss? What's their people talk a lot about credit score. We use the term insurance score, right? Which is a mix of credit, mix of losses, mix of insurance history. Have they had spotty insurance history? And carriers are starting to rate up based on that, in addition to the property, where you're seeing a lot of
how are they going to go about doing that?
right.
As far as because
Name and
usually,
address.
but usually, usually one of the things that you don't get sent by us is leases, right, with names and all.
Yeah,
that
so-
stuff, but
Right. So this is I'll give you guys an example,
Yeah.
right? So
Yeah.
we talked
just
earlier
out of
about
curiosity,
yeah.
so.
the personal lines thing, the
Yeah.
algorithmic
Yeah.
home and auto rating, right? When I go into a major Main Street market and put your name, birthday, and address into the system, it pulls cars that you've owned for me, residence, credit score, everything. So think about it this way. If that information is already out there, right, and we're putting in the address for the apartment building, right, which is all your residence street address,
Yeah.
right? When it is going through, it's pulling all that information. Now, it's not granular down to this individual person or this unit, but it's taking that aggregate score.
Of the property.
Mhm.
Yeah.
Yeah,
okay.
yeah.
I thought you were talking about each individual tenant.
No, you're not gonna have
I was
to
like,
like
how are you
tell
gonna do
C1 to move out so you
Yeah,
can save on insurance. No,
Yeah.
not that granular.
I was like, whoa, so.
Yeah.
Bobby.
Yeah, so when you guys do the initial thing, do you do it off each unit of the thing, or do you do it off just the overall building?
Yeah, and I want y'all to know too, like, don't get too myopic on when you're evaluating these. Obviously, if it hits like the big check boxes, but you have like 1 or 2 units, 10% of the total units that have some issues, that's okay. The bigger things that we're looking at is, and kind of like cover the camera, like traded.
Yeah.
We're gonna have the more doors we have, the more residents we have, the longer that we hold these properties, we're gonna have issues, right? Whether it is a casualty claim, liability, somebody punches somebody, they try to hold the property owner liable. Dog bite is a huge one. and just property losses, but like one of the things that we try to do is we're looking at like, is this something that we want to claim, right? Do we want to tarnish the loss run and potentially look at like a 30% rate up on the policy? Whereas, we may be able to be making a new purchase and the property is a little distressed and we have some issues. We may be able to take loss runs, information from Brian and Jana, the listing agent, and create what I call an underwriting narrative where we talk about, hey, we know we got issues. When we bind this policy at purchase, we're going to take actual cash value roof instead of replacement cost roof. And our goal is to put a new roof on in the next 6 months. And this is how we're going to do it, right? Hey, 80% of units have HVAC systems and window that have been replaced, going up to 2015, but we still have 25% to do, or maybe my percentages are off over 100%. But regardless, so because of that human component to the underwriting with commercial, I'm able to leverage a little bit instead of getting just like a flat no. And obviously, there's going to be some challenges as that capacity and underwriting shrinks. So.
Well, when we're talking about agency, one of the things, because I always thought at the very beginning, when I started doing the multifamily, I'm like, well, hey, insurance rates ought to be real good on Fannie Freddie just because of the fact that they're so picky about their properties.
Yeah.
Right. So knowing that how much, they're checking all the wiring and they're checking all the HVAC, I mean, all of that stuff, and being so picky, I was like, okay, insurance rates, I would think it'd be a little lower just knowing how much they check everything and all of that, but that's not the case.
That is,
but what you
not the case.
explained
Yeah.
about, okay, well, it's because of that non-recourse type of language, which is great, but on the insurance side is not necessarily helpful.
Yeah, so one thing about habitational investors that makes me a little nervous, I've gotten over it mostly, but being an insurance agent, I always say, like, I'm a coverage first agent, right? Price is a secondary consideration for me. When we have a loss and we don't have enough coverage, nobody ever comes and says, thank you for that great deal, right? You saved me so much money, right? Because when we're talking about cost of insurance, we have to factor in uncovered loss to the cost, right? So, the example here is we have a purchase price on a property. Fannie and Freddie come do their thing. They say, hey, it looks good. The loan is X, right? And a lot of times in the commercial space, unlike with the multifamily space, especially, unlike with like you try to go to East Nashville and buy a home that was built in the 1940s and it's 1,500 square feet and they want like $700,000. You could probably build that home twice, right? When we insure it on the personal side, even if we went, $200 a square foot, $250 a square foot, like we're going to be well below the purchase price, right? When we start talking about high square footage multifamily, when I first started doing this about 5 years ago, I had, essentially like loan to square footage ratios that would be like $68 or $70 a square foot, right? Purchaser brought a lot of money to the table, whatever it was, right? And that is what I would consider in those situations very aggressively insured, which meant if this thing turns to dust, we may not even get a contractor to come out here and bid it for what we got on the square footage. So when you get into Fannie and Freddie, their insurance guidelines are available online in the handbook. If you guys would want to look at it, it's one of those things that has to be available. It's a resource that I use a lot. They are going to cover both sides of the CYA. The first one is going to be the property. They're going to require at a minimum the loan and depending on the carrier, if they say, the last few that we have done that were Fannie and Freddie, they didn't allow co-insurance. So you've got to get agreed value. And just to talk about co-insurance for a second too. Co-insurance is, as a commercial property owner, I have an opportunity to insure to a percent of value without penalty. So, $100,000 building, I insure to $80,000 with $80,000 co-insurance. The building burns to the ground, insurance company pays me $80,000. If I insure to $80,000 and the value is $110,000, I am underinsured by a certain percent. So my $80,000 settlement is then reduced to the percentage that I was underinsured. Okay. So that is like when we talked about that aggressive insurer, he can confidently insure to 80% because he's willing to self-insure a lot. If he slips a few percentage points below and gets penalized, not a big deal, right? Most carriers, if they're going to remove the co-insurance penalty, require you to insure to 100% of value, not loan. And like we were talking about, like in these situations where you've got 20,000 square feet and replacement cost estimators coming in $175, $180 a square foot, maybe you have 1.7 or 2.3 in the property, the insured value is coming back $7 million. I mean, the premium is spicy, right? And we don't have an option then because gotta satisfy the bag man or woman, whatever.
Well, and I'm sorry that we could have talked forever. Like you say, because we got all of what, 3 minutes or something.
Okay, all right, cool.
So anything you want to say in closing?
Yeah, very similar to what Trey was saying. Biggest thing, I'm super passionate about this. Big insurance nerd. Conversation with me is not limited just to clients. I just really love people anyways. So thank you, Brian, Jen, and the SVN team. Let me come out. And if anyone has any questions, want to grab coffee, lunch, whatever, I'm available. I got business cards and we'll connect.
And as you can tell, he's very kind of like Trey, passionate about what he does, right? So he can talk to you all the gory details.
Yep.
Everything there is when it comes to to insurance wise. So I want to thank Taylor for coming. I want to thank Trey. Also want to thank our sponsors. Make sure because I know that Billy Joe doesn't want to take all those
Cakes?
cupcakes. Those are fun cakes. So you gotta nothing but. So you gotta take one on the way out too. By the way, you can take a box too if you want. But I want to thank Next Gen Management, Billy Joe and Katie for being here tonight and sponsoring our learning series. As we say, we hold these so that you can to teach folks how to increase their standard of living so they can increase their standard of giving. We're very, very big on being able to give back. That's one of our main mottos here at SVN Excel Commercial Real Estate is to do that, is to provide education. Like I say, we do these monthly. They're free, right? Free education. So you're welcome to bring friends, colleagues, family, whatever, come out and join us. And you can zoom in. We have plenty of Zoomers. Many times they come from different parts of the country because we have clients that are, all over the United States. But again, we appreciate you coming out tonight. Thank you to our speakers. Thanks to our sponsors, and we'll definitely see everybody next month. So thank you again.